Welcome back to Investing Talk Podcast.
Great to be here.
Today we're zeroing in on a major name in American steel, Cleveland-Cliffs. Now, they're the biggest flat-rolled steel producer in North America, which sounds, incredibly solid.
Absolutely, a giant in the field.
But then you look at the recent numbers, and there's a $1.67 billion net loss staring back at you. It's quite the contrast.
It really is. That catches your eye immediately.
So is this just a dip, the kind of thing that happens in a cyclical business like steel? Or is it something more worrying for potential investors? That's what we're aiming to figure out today.
Right. Sorting through the noise, looking at the data.
Exactly. We've got the financial reports, market analysis, what the experts are saying, and we want to boil it all down for you. The big question, is Cleveland-Cliffs a good buy right now?
A very timely question.
And hey, if you enjoy this kind of analysis, please do subscribe, like this episode, and leave us a comment. Maybe even consider buying us a coffee. The link's below. And if there's a specific company you want us to look into next time, let us know in the comments too.
Yeah, we love getting those suggestions.
Okay, so Cleveland-Cliffs. Let's unpack this apparent paradox. To really get a grip on Cleveland-Cliffs, we absolutely have to start with their basic financial health. And like I hinted, the numbers paint a really interesting, maybe even contradictory picture.
You see that revenue first.
You do. Trailing 12-month revenue is $18.46 billion. I mean, that's a massive number, no question.
Handily substantial, yeah.
But then, boom, the contrast hits you. The company reported a net loss of $1.67 billion,
Ouch.
which translates to an earnings per share of negative $3.43.
Mm-hmm.
So what that screams pretty loudly is that profit margins are, well, deep in the red right now.
And there aren't really immediate signs pointing towards near-term profitability, are there? Based on the recent earnings, at least.
Not really. And if you look at what analysts are saying, the consensus expectation is for only a marginal, like 1% price increase over the next year.
Which is just pretty low expectations for a quick turnaround, doesn't it?
It really does. Subdued is a good word for it.
Yeah, and what's really striking here is just how, well, brutal the steel sector can be. These financial pressures, they just hammer home that volatility inherent in the industry.
So when you dig deeper into the financial health, what else stands out?
Well, you see the market cap at $5.15 billion, but it's those consecutive net losses and maybe more importantly, the lack of positive free cash flow trends that really tells a story.
Free cash flow being the cash left after running the business and reinvesting.
Exactly. The cash they generate after covering basic operations and capital spending. Without that positive flow, it strongly suggests, significant debt levels.
Right, because it's hard to pay down debt or return value without that cash.
Precisely. It signals a deeper financial strain. And look, the company isn't paying dividends either.
Which is usually a sign they're holding on to cash.
Absolutely. It's a clear signal management is prioritizing liquidity, just keeping cash on hand over shareholder returns right now. Cash flow is just constantly under pressure from those wild swings in steel prices and, of course, the challenge of managing production costs.
And you mentioned volatility.
Oh, yeah. And that's quantified by the beta. It's high, 1.99. So think about it this way. If the overall market moves 1%, Cleveland-Cliffs tends to move almost 2% in the same direction.
Wow, nearly double the market's move.
Yeah. It's not just a statistic. It means an investment here is going to feel the market's ups and downs almost twice as intensely. It makes for a much wilder ride in your portfolio.
So if the market catches a cold,
Cleveland-Cliffs gets pneumonia. It amplifies everything.
okay, that beta number definitely paints a picture of a bumpy ride. So given this financial strain and the inherent volatility you described, how does Cleveland-Cliffs actually position itself? What's its competitive standing in this tough sector?
Right. And what often surprises people is that despite all that red ink we just talked about, Cleveland-Cliffs isn't some minor player. It absolutely has a competitive edge.
Because of its size.
Primarily, yes. It's the largest flat-rolled steel producer in North America. That scale gives it a really strategic position. They can be a dominant player, and they're set up to benefit significantly from infrastructure demand. Think bridges, roads, buildings.
The kind of stuff those stimulus bills are aimed at.
Exactly. And potentially from future steel tariff removals, too, which could lower their costs. But, and this is a big but, we always have to remember steel is cyclical. It booms, it
And the
robust.
global competition.
Intense. You've got rapidly changing cost structures from producers all over the world. Now, Cleveland-Cliffs does have product diversification, hot-rolled, cold-rolled, various specialized grades, and that provides some resilience.
But not immunity.
Definitely not immunity. It doesn't eliminate the exposure to sector downturns or those commodity price pressures. And a critical risk here, tying back to those big mills and machinery, is their high operational leverage.
Meaning a lot of their costs are fixed.
Precisely. Think massive steel mills, heavy equipment, fixed labor costs. So even a relatively small drop in steel prices or demand can lead to a disproportionately large hit to profits or ballooning losses, as we've seen.
Which explains how those revenue drops can turn into such huge net losses so quickly.
It's exactly why. That leverage cuts both ways.
Okay, so we've seen the red ink, the competitive landscape, the operational leverage. The next big question for any investor has to be, what's the market actually saying? How is it valuing Cleveland-Cliffs right now, especially when it's losing money?
Yeah, you've really hit on a crucial point there, because the traditional metrics like the price to earnings or PE ratio, they just don't work when earnings are negative. They're not meaningful.
So what can we look at?
We can look at the price to sales, or PS ratio. Right now, based on its market cap and revenue, it's around 0.28.
0.28, that sounds really low. Doesn't that usually signal undervalued?
Well, typically, yeah, your gut might scream bargain when you see a low PS like that. It looks like a classic undervaluation signal, right? But here's the analysis insight. It's probably not some hidden gem the market's missed. It's more like the market being brutally honest and saying, look, we're pricing this company for its losses, for its current struggles, not just its potential.
So it's not really a discount. It's more like a reflection of the problems.
Exactly. It's a mirror reflecting those deep operational challenges we discussed.
Okay, that makes sense. But couldn't a contrarian investor, someone looking for that turnaround story, argue that this is the opportunity, that the market is just being overly pessimistic?
Oh, absolutely. That's a perfectly valid contrarian viewpoint, and it's certainly how some investors play these highly cyclical industries. You bet against the pessimism. But when you compare Cleveland-Cliffs to historical steel sector averages, sure, it looks cheaper on that PS basis, no doubt, but it's also undeniably riskier. Why? Because of the negative net income, the ongoing cash flow uncertainties we talked about.
So the market isn't just being gloomy, it's reacting to real financial pain.
I think that's a fair assessment, yes. It's reacting to tangible current issues. And when you look at valuation models, well, analysts' price targets average $10.52, but the range is really wide.
How wide?
Very wide, from a super bearish $3.91 up to a bullish outlier of $17.
Wow, that spread tells its own story about uncertainty.
It really does. It shows just how much disagreement or maybe just lack of visibility there is. Most analysts are likely using relative valuation comparing it to peers because the cash flows are just so volatile. Doing a discounted cash flow model, that would probably only give you strong positive values if you assume steel prices recover sharply and stay high for years.
Which is a pretty big if.
It's a huge bet on a very specific and quite dramatic turnaround scenario.
Okay, understood. We've walked through the financials, the valuation hurdles. Now let's get into the nitty-gritty. What's the actual stock trading behavior telling us? Are the charts confirming these headwinds, or is there maybe a different story playing out there?
Well, the charts, they definitely paint a picture of ongoing volatility. The stock's been trying to find its footing, really. Recently, the price has been bouncing between, say, $10.41 and $10.97.
And the wider range over the past year.
That's been pretty broad, too. It's gone from a low of $5.63 all the way up to $14.34. So quite a swing. Currently, the price is actually sitting pretty close to that average analyst target we mentioned.
Okay. Any key levels traders are watching, support or resistance?
Yeah, technically, we're seeing what looks like solid support down in the high $9. That's a level where buyers tend to step in.
Yeah.
On the upside, there's resistance nearer to $11 or $12 levels where it often struggles to push through.
And the short-term outlook based on models?
The quantitative models are actually quite bearish in the very short term. They're predicting a potential drop to around $9.56. That would be about an 8.16% decline over the next 30 days or so.
Oof, that's significant.
It is. And volatility is up there, near 8%. Plus, if you look at the last 30 trading sessions, only 43% were green days the stock closed higher.
Less than half. So more down days than up days recently.
Exactly, indicating more downward pressure lately.
What about key technical indicators like moving averages or RSI?
Sure. So the 50-day simple moving average, often seen as a shorter-term trend indicator, is at $9.02. The longer-term 200-day SMA is actually higher at $9.60.
And when the short term is below the long term.
That's generally seen as a classic bearish signal. Yeah.
Yeah.
It suggests recent weakness and that the prevailing trend has been downwards.
Okay. And the RSI, Relative Strength Index.
The 14-day RSI is sitting around 48.3. That's pretty much smack in the middle, neutral territory. It means the stock isn't technically overbought or oversold right now.
So no immediate signal from RSI for a big bounce or a plunge.
Not from that indicator alone, no. It kind of paints a picture of a stock that's been trending down, had maybe a little technical bounce recently towards $10.50, but is now just sort of sitting there. No strong immediate technical push upwards.
So overall, technically speaking,
Overall, the trend was clearly down in July. We saw that bit of a bounce, but the general setup, it still looks volatile. And market sentiment reflected in these technicals feels neutral to maybe even a bit fearful.
that certainly doesn't sound like a ringing endorsement for, near-term momentum.
Mm-hmm.
So moving beyond the pure numbers and charts, what's the market pulse? What's the latest news? What's a general feeling, the sentiment around Cleveland Cliffs?
Well, there was some potentially significant news back in July 2025. Discussions about removing steel tariffs between the U.S. and Mexico.
Tariffs. Always a big factor for steel.
Absolutely. If those tariffs are actually removed, it could reduce costs for Cleveland Cliffs, possibly quite significantly, and that would help their margins.
A genuine potential positive then. Lower costs could mean better profits if prices hold up.
It would definitely be a boost, yes. And then sort of in the background, you have the broader U.S. infrastructure spending push. That provides a positive long-term context for steel demands generally. It's a potential tailwind building over time.
Okay, so some potentially good news on the horizon. But how did the stock actually trade around that time?
Well, that's the interesting part. Despite that potentially positive tariff news, the stock actually traded down 3.74% in July.
Huh. So the market wasn't buying into the optimism.
It seems not. It really highlights the persistent uncertainties in the sector, doesn't it? It shows that even with potentially good news, the market is still very hesitant, very cautious.
And what about the overall analyst view? You mentioned the price target earlier.
Right. The overall consensus is technically a buy, but with that very modest upside, only about 1% projected over 12 months. And importantly, a lot of individual analysts actually rate it as a hold.
So kind of a lukewarm buy at best, with many sitting on the fence.
Exactly. It tells you there's this underlying skepticism due to those cyclical headwinds and the sector volatility, even if they aren't slapping sell ratings on it.
Any insider buying or selling. People within the company making moves.
Nothing notable was disclosed in the recent results. No big buys or sells from executives or directors reported.
And general sentiment? Social media? Retail investors?
Seems pretty neutral, actually. Nothing strongly positive or negative bubbling up there. And, maybe more telling, the broader fear and greed index for the market is indicating fear.
And when the overall market is fearful.
That can definitely put a damper on buying interest for individual stocks, especially cyclical ones like this, in the short term. Fear makes people cautious.
That's a really crucial point. Even if there's potential good news for a specific company, how much does that broad market fear hold things back? Can good news cut through that kind of widespread worry?
It's incredibly difficult, honestly. Think of it like, the tide. When the tide's going out, when fear is dominant across the market, even a fundamentally strong boat, or in this case, a company with a strong market position like Cleveland Cliffs, can get dragged down.
Because investors just get risk averse.
Exactly. They pull back, they prioritize preserving capital, positive catalysts for a single stock might get discounted, or just fail to gain any real traction. The macro environment, especially one dominated by fear, often just trumps the micro-level good news, at least in the short term.
So even if those tariffs get removed?
The boost might be muted or delayed. If the overall market is still scared and selling off, it really raises an important question for investors. Are you willing to sort of fight that outgoing tide, or do you wait for the broader market mood to improve first?
A tough calculation. Okay, so on that note, looking ahead, what could actually move this stock? What are the potential positive catalysts that might push it higher? And conversely, what are the big risks that could send it lower? What's on the horizon?
Okay, short-term catalysts. The next earnings report is absolutely key. That's expected around July 21st, 2025. Any surprise there, positive or negative compared to expectations, could really move the needle sharply.
Earnings are always crucial.
Always. And of course, any concrete news on those potential U.S.-Mexico steel tariff changes. That's another big one to watch. Given how volatile this sector is, any significant earnings beat or miss or definitive tariff news could cause a sharp reaction in the share price, up or down.
And thinking longer term, beyond the next few months.
Longer term, that U.S. infrastructure stimulus we mentioned, if that really translates into sustained strong demand for steel over multiple years, that's a major positive, a significant tailwind.
That makes sense.
Also, broader global trade policy changes things like tariffs, quotas. If the U.S. continues policies that protect domestic steel, that could benefit Cleveland-Cliffs. And, you can't rule out industry consolidation, M&A.
Mergers and acquisitions.
Yeah. In tough environments like this, sometimes bigger players look to buy smaller ones, or maybe even similar-sized companies combine to try and find efficiencies and scale benefits. That's always a possibility in cyclical industries.
Okay, those are the potential upsides. What about the risks? What keeps you cautious?
Well, on the stock-specific side, the biggest ones are right there in the financials we discussed. That persistent unprofitability and the negative cash flow. Those are major, immediate concerns.
And the operational leverage?
Still a big risk. That high operational leverage and the sensitivity to steel prices mean any downturn gets amplified. Then there's regulatory and tariff risk policies can change, sometimes suddenly, shifting the whole competitive landscape. And even being the biggest in North America, they still face that intense global competition.
And broader market or sector risks?
You always have to factor in the inherent cyclicality of the steel sector itself. It just goes through these cycles tied to the economy, fluctuations in commodity prices, especially iron ore, coal, energy. Those directly hit their costs.
Right, their input costs.
Exactly. And finally, any major macroeconomic downturn that hits construction or manufacturing demand, that would severely impact their order books and revenues. That's always a background risk for companies like this.
Okay, so we've really dissected Cleveland-Cliffs from, well, pretty much every angle. The financial struggles, the competitive strengths, how the market's valuing it, the technical picture, the news, the risks, the catalysts. So let's try and bring it all together. What does this mean for someone listening right now, maybe considering an investment? What's the bottom line? Is Cleveland-Cliffs a good time to buy?
Okay, pulling it all together. Based on everything we've discussed, our overall rating for Cleveland-Cliffs right now lands at a 4 out of 10.
A 4 out of 10, so leaning cautious.
Definitely cautious, yes. Look, while Cleveland-Cliffs is without a doubt well-positioned as the leader in North American flat-rolled steel, it's facing immediate and pretty significant financial challenges. We're talking negative net profits, consistently pressured cash flow, and that high volatility we keep mentioning.
And the low valuation metrics aren't necessarily a bargain signal.
Exactly. Those low valuation numbers, like the PS ratio, we need to remember they largely reflect the sector pessimism and the company's deep operational issues, rather than indicating some kind of hidden, undiscovered value. Analyst consensus points to only very limited upside potential, and the technical charts, as we saw, suggest a near-term risk of further price decline.
So a real turnaround depends on?
A real turnaround hinges on achieving sustained profitability and seeing a recovery in their profit margins. And frankly, that's just not immediately visible right now, although those potential catalysts like tariff changes or infrastructure spending could certainly help down the line.
So how should different types of investors think about this, short-term versus long-term?
Right. So for short-term trading, it just doesn't look favorable at the moment. You've got that predicted near-term price drop risk and the high volatility. It really only seems suitable for highly skilled traders who are genuinely prepared for significant risk and very quick, sharp movements.
Not for the faint of heart.
Definitely not. Now, for long-term investment, it really falls into the category for contrarians, people with a very high tolerance for risk, who are willing to be patient and wait for either a broad recovery in the steel sector or for those major positive catalysts like infrastructure spending to truly kick in and materialize.
So for most typical long-term investors?
For most, it's probably best avoided or at least put on a watch list until the financial fundamentals stabilize and start showing clear, sustained signs of profitability again. Wait for proof the turnaround is actually happening.
Okay, that's a very clear summary. As we wrap up this look at Cleveland-Cliffs, here's something to think about. In this age where we're flooded with information, how do you decide when a company's deep financial challenges, like the ones we see here, outweigh its strong market position and those potential long-term catalysts?
It's a tough balance.
It really is a complex balance, and understanding those nuances, weighing the pros and cons we've discussed, it's absolutely key to making informed investment decisions. Thank you so much for joining us for this analysis.
My pleasure.
And we look forward to our next exploration with you here on Investing Talk Podcast.